Hello, everyone, to another monthly edition when I come and speak to you about India, macro, investing, and generally what is happening globally as well. Today, we'll focus a bit more on India because, as usual, there is the budget that came out 2 days ago on February 1. Although we've always said that, budget is mostly noise. And what we at Quantum focus from the budget is what has the government taken steps to do for rural India, for consumption, for just income increasing, and what are they spending for the long term in terms of capital expenditure and different infrastructure projects. And then we look for there are any negatives from a tax perspective, because India, we have to remember that India is dependent on capital and more so on foreign capital for its growth, right? So unnecessarily changing or tweaking any tax changes which can ruffle the investing sentiment for foreigners is always a negative, right? I think from this government perspective, I think this is one thing that they've realized very well, that not having any major negative is actually a very good positive, right? So successive budgets we have seen over the last 3-4 years, that there's no major negatives to ruffle any large section of investing sentiment or population, and which means that the response to the budget from a market perspective is generally good. Some sectors will always have some impact, but broadly, if you maintain a continued framework of governance, rule of law, and opening up of markets and activity, that's what tends to give more sentiment. I think this government does very well on that. They've also continued on what we call the fiscal consolidation, although India's debt to GDP and fiscal deficit remains high post COVID, but they've given a framework and they're trying to follow that framework, especially so this year, because next May 2024, as you know, is the general election, and this is the last full budget that this government can submit. And there were apprehensions that this will be populist, although we like it. We like more spending for rural India, more spending for consumption, because that is a segment that we think needs support and recovery after all the shocks that it has seen over the last 3, 4, 5 years. So we were not very worried about, but the market was worried about that it will be more revenue spending, more subsidy, and less capital expenditure. But that has not been the case. In fact, they've made an increase in capital expenditure to a fairly large extent, almost to a point where people will question whether the government has the ability and the efficiency and the mechanism to be able to spend 13 lakh crore in a year in capital expenditure just by the center. So, but they've announced it, center and the extra budgetary, as we call PSUs. They've announced that plus the state spending. And we have to see whether that goes through. But that is generally very good for the long period of time, right? As you build more infrastructure in railways, roads, ports, airports, water, sanitation, these things have, impact for the long period of time. That was very, very good to see. As we said, we were disappointed that there were cuts on the, Manrega, the Rural Employment Guarantee Act. There was not major income spending that we still think is required, because if you see, consumer demand has still not picked up as much as the other segments of the economy. So that was a bit of negative, but the government is hoping that as they spend more on capex, that demand will flow through to consumer, and then eventually consumption and income will also recover. We'll have to wait and see. We still believe India is on a cusp of a upward cycle. But what that means is that India is still growing at about 5.5-6% real GDP long term. It is still not growing at that 6.5-7% that it requires to be able to create jobs and opportunities for people. But there is a secular improvement. India is in a structural and secular upturn in terms of business cycle, residential real estate. I think that will remain and that will continue for a period of time. There were some tax changes which you would have read about, both from a personal front and also from tax changes which impacts insurance, which we generally believe is good for mutual funds. Mutual fund we believe is a much more efficient, long-term, low-cost vehicle for people to allocate. and it is an investing vehicle as compared to insurance, which is used as an investing vehicle, but it is basically a risk mitigation. I, Aligning that is generally good for mutual funds. There was also another very large change that the government made on Indians investing or taking money out of India through their liberalized remittance scheme. And now they already had a tax collected at source, TCS as they call it, at 5%. Now they've made it 20% without threshold, which means even if you want to buy, as an Indian, you want to buy Google or Amazon or international stocks, you now have to set aside a portion of tax, pay that tax, then invest, and then you can claim it at the end of the year. I think this creates one more hindrance barrier for people to directly invest in stocks or mutual funds abroad. And again, is hence beneficial to the Indian mutual funds, which are offering international of schemes which invest in international funds. And I think at Quantum Mutual Fund also there is a idea and thought and proposal to, as part of our overall asset allocation, we would have heard about 12, 20, 80 that we offer for Indian investors as a solution. We also believe that there has to be some diversification away to international stocks as compared to only being India specific. And we would be launching India asset allocation. And this rule of taxing direct investment as compared to investing through a mutual fund in India should be beneficial for that product. So look out for that whenever that comes out, and you can get in touch with Quantum Mutual Fund to get more details on that. In terms of the impact of the budget on the markets, from a bond market perspective, as we've been saying for the last 6 months, I think it's getting better and better for both kinds of investors who invest in liquid funds or bank deposits, because rates are going up, as well as if you're slightly longer term, 2-year, 3-year, outlook. It's also getting attractive for bond funds, India bond fund, like dynamic bond funds, for instance, because there was no major increase in the fiscal deficit. It was in line with expectations. The budget numbers are very credible. So, they should be able to achieve what they've set out in terms of revenue as well as in expenditure. And which also means that the RBI will take this budget as not being too inflationary, which could mean that maybe another 25 basis points or hike, or just about at the same level, maybe they will pause. So we don't see a major increase in repo rates, RBI policy rates, which is generally a good sign for bond funds, because today we have government bonds trading between 7% and 7.5%. The entire curve is around in that band, and corporate bonds are even slightly higher. And those are generally good entry points over a 2-3 year period for bond funds. And I think that will continue to remain, and eventually returns over a period of time should kind of potential should kind of improve as you invest more over a period of time in this. From an equity market perspective, especially if I look at the quantum value equity strategy, I think the ongoing that has happened, and this budget should be even better, because when the government does capex, the economy has a broad-based impact. There is a broad-based recovery, there is a broad-based activity, and that tends to be generally better for our style of investing, where we where for value style of investing, as compared to very concentrated increase in the economy, or very few stocks or very few companies or very few sectors benefiting, which we saw in the period between 2016 to 2021. But now we are seeing the broad basing of the economy, and these broad spends in capex across sectors should be beneficial for different companies and hence the different economy. Also, given that there was no major consumption income support, we believe that valuations of certain growth stocks will continue to remain under pressure, because we are not seeing that kind of growth coming through. So that's again benefit for a value style investor like us. And third, mostly you would have seen there have been concerns of governance in certain companies, and we at Quantum, we've always believed that to be the biggest hurdle or important decision making point to invest. That India is a great opportunity. If you remain invested in India for the next 10, 15, 20 years, as it has been for the last 10, 15, 20 years, you will compound your returns and wealth in a very good manner, subject to you being aware of the risks of liquidity, the risks of governance, and the risk of what we call reputation and headline risk. And that is very, very important to note. And given that at Quantum we always have managed it, that's why we call our strategy value investing with values, which means it has an integrity screen to sift out certain managements, certain businesses, certain sectors where we do not believe we have a very good view on the management or on the business or on the sector to be able to protect minority investors over a long period of time, because we are long-term investors. So we stay away. It hurts our performance when such companies, such sectors do well, but it also benefits us when there is a period of scrutiny. A major investors are looking for where is the other risk, where are the other governance risks. That period tends to be better for us, and better for general investors also. When as the ecosystem gets better and investing, you get more confidence in investing in different kinds of managements. That same thing applies when people invest in index, right? So index investing and ETF is a great way to participate, very low cost, it's easy to understand, easy to replicate. But index companies or companies in the index also have this issue of governance, right? How do you deal with those kind of things? So like when we tell this to global investors like pension funds and sovereign wealth funds who are fiduciary investors, that they can happily invest in an index, but how do they manage risks of reputation and governance? And so that's like another thing that investors also have to think when they allocate to India over a long period of time, which also plays out to not only in our value with values fund, but also in our what we call the ESG or responsible returns product, where governance is the largest allocation. It looks at environment, social, and governance, but if 50% of the weight in the way the ESG fund picks stocks is based on governance. And as markets reward and see that companies with good governance generally tend to have long-term returns, and it's much more kind of, I won't say safer, but confidence of investors is higher in such companies. And then the thesis of long-term investing with companies in good governance should do well. So that's the way we think about investing, we think about markets. I think, but we don't believe that such incidences or instances generally takes away. It's not a message against India, right? And there are investors realize that there are enough companies and opportunities and growth in India for the long period of time, subject to being aware of what kind of risks that you're taking on. So I think these generally, if you see, we will still believe that India is will attract more capital. India's relative performance this year, or at least in the last 6-7 months, has been lower. India has had an outperformance against emerging markets, against global indices for the last 2-3 years, but now we are seeing that underperformance. What we actually believe is that as India underperforms relatively, the chances of foreign investors again reallocating back to India remains high, and we should wait for that, look for that, and I think that thing will play out as the economy keeps its upturn in the months and years to come. So thank you very much, and happy to take if you have any suggestions and feedback, please write to us. I'll be happy to answer those questions. Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.